Hello and welcome back to details of balance sheet. In the previous lecture, we learned a lot about the non-current assets. In this video, we will be talking specifically for current assets. Even though we touched a little bit on the current assets in the previous video, we will be looking at it in details. So the current assets usually compiles of inventories and some financial assets like current investments which can be sold or are going to be sold within 1 year. Trade receivables means the customers outstanding from customers where the company has to recover the money. Cash and cash equivalents. Cash equivalents means bank, short-term treasury bonds, which can be redeemed on demand. Loans, which the loans you have given to your suppliers or to your employees or to anyone else, to your group companies. Other financial assets like advance tax or other deposits and other current assets. So now we will be looking at it more details on what this particular balance sheet is having. So to know more details about this, we need to go into these schedules. So let's go and have a look at it now. These were all the assets, non-current assets. We looked at it now. The inventories. Inventories here, as you can see, it comprise of raw material $19,000, work in progress 5,000, finished goods 10,000, stock in trade, and stock and stores and repairs. Now what we need to understand is how these are valued. There are a few principles where we follow for valuing these inventories. Some like, for example, weighted average cost method, or first in first out method, or you might be hearing last in first out, weighted average. But most importantly, these inventories are supposed to be written down to the net realizable value. For example, finished goods, they are worth $10,000. What will happen if tomorrow these finished goods are the real market price? For example, because this is a petrochemical company, what happens to the fact that whatever is the price you are having now, next month the price of petroleum is going down? You know that from your finished goods at the time of balance sheet, you will not be able to recover the value. So will you adjust? Or you know already at that, because this is the cost of producing, the cost is cost to produce finished goods. What if the market price is already low and you cannot even recover your cost? So by accounting standards, by prudent accounting standards, you are supposed to write down the value. So you need to make it cost or sale price, whatever is lower. These costs are purely on cost of raw material plus certain labor, direct labor, which is involved in producing these assets. There are a lot of the cost of the valuation models, valuation methods from one company to another company can differ. Some if they are not following international financial reporting standards, the interpretation of international financial reporting standards or the accounting principles followed by the company can be different. Some companies may add the cost of materials and plus the cost of labor. Some companies may add some percentage of direct overheads, factory overheads, rentals, interest, even though they are not allowed to be added by the financial reporting standards, but company can do, because you have no control over the valuation of these things, and it's entirely up to the auditors to certify that this value is reasonable. There's always a gray area for creative accounting to increase or to decrease the value of inventories. How we can know? From looking at the financial statements, there is no way we can do it. However, if you are considering to buy any company, if you are considering to put a heavy investments, so it's good to do some due diligence. Now, if you are the preparer or you are the owner of the financial statements and you are reading for your own company, you need to ask your managers or directors of finance or chief accountants how they value these things, because sometimes there are a lot of frauds happening in around cash mishandling. So these are the accounts where things can be hidden very easily and you will not be getting any idea about how much is the real value of these inventories. So you need to be careful and ask them for more details. The next item in the line was investments, current investments. Now the current investments, as we said earlier, are mostly which can be realized or can be sold within 1 year and are intended to be sold within 1 year. So here in this, for this particular company case, you can see they are investing heavily on the mutual funds, $21,000, investment in the government securities or other treasury bills, in debentures of the government of India or other companies, and then there are other mutual funds unquoted, means they are not quoted in the market price, they are not quoted on the market place. So here as well there are a lot of gray areas where company can park funds or company can hide the losses or gains. This is not necessarily the market value, it's a fair value, the investment measured at a fair value. Fair value means that if you buy certain items at $10 or $100, you need to see the fair value of the in the books of the investments. Maybe that particular company has just made a heavy losses, so the fair value of the investment is going down. But if you want to hide it, you can hide it easily. You just no need to show it out, right? But the losses has been occurred already. Or sometimes you may want to give the investments to your related parties who are not having any intention to return, but you can always classify them as current. So as a user, as a auditor, or as the person who is controlling the financial statements, you need to ask for more details. Unfortunately, the annual reports or the public financial statements, they don't give these kind of details. It has to be come from the company or the person who prepares, and it's available mostly to the senior management or to the owners only. Now from the point of view of financial reporting standards and from the point of view of stock exchange listing requirements, there are certain categories also which are required to be mentioned for these investments, like financial assets measured at amortized cost. Like here you can see they have recognized on amortized cost only 585, which means that there are certain asset investments where the value has gone down significantly below the cost price, how much they bought it. So there has been a loss occurred on that. There are investments through the comprehensive income, means there has been losses recognized on those, and then through some profit and loss. We are not going to too much technical details of these things, because those are not really daily or small scale things, but it's just good to know. Now the next item was trade receivables. Trade receivables are as we said earlier, it's company's accounts, customers dues which company has to recover. Now in this year you can say that, oh, the investments has the trade receivables have increased from $5,000 to $10,000. Can be any factor. These are usually, we need to see the ratios of how many days company is receiving its money or collecting its money. We will be looking at it in the next lectures when we do the ratio analysis. So for now, and we just need to see that, okay, there are trade receivables, they are unsecured and considered good. If there is any trade receivable which is considered doubtful, where the recovery is not 100% sure, you need to recognize that as an expense or amortization in the period when the fact is happening that the money will not be able to recover, and we can show it here. $10,000 minus, let's say, out of this 1,000 will not be able to recover. So we can say 10,000 minus 1,000, balance is 9,000. So that 1,000 will go to the our income statement as a loss. Now, next item in the line was cash and cash equivalent. So here you can say that cash in hand is only very small, 8 crores only, and then the balance is bank is quite a huge sum of money. Now you can always see as a user of the financial statements that, oh, the company should have probably managed the bank better, because there's a whole lot of money lying in the bank which should have been used for a lot of other investments, short-term investments, so that you can make some more money, right? But yeah, those are the things that can be managed. Sorry. The next in line was loans, current and considered good. Now these loans are, we need to show these loans are to who. Here is a loans and advances to related parties, means that the loans are going to our own individual, our own companies, their own companies. Their related parties are referred to the companies where the board of directors and shareholders are same, or the parent company can exercise significant control over the management of those parties. We will not look into the deep details of what are the related parties. You can refer to the accounting standards or in the country, in your native country. Then there are other financial assets which are called current assets. Now it's interest accrued, deposits, small things, and then others include fair value of derivative. Here also they are doing hedge funding, which is sometimes to prevent the losses on foreign exchange or other type of derivative, or other type of like futures, call options. So these are the small other type of investments. Here also the valuation is important to see how they are valuing. Are they recognizing all related expenses or written loss of value or not? Now, these were all about the assets. In the next video we will be looking at liabilities. Stay tuned. Thank you for watching.